Let's go now to our friend Bimnet Abibi from Galaxy Trading. As always, Bimnet, great to see you.
Thanks for having me. How you doing?
I'm good. How are you doing?
Hanging in there. It's the middle of August, you know.
That's what I was going to say. Like we've had a little bit of excitement finally.
We did.
But overall, it feels like a long summer. There's been lots of doldrums. I'm not sure what a doldrum is, but but we had some volatility
Absolutely.
last week, sort of right after we recorded last Thursday.
It was ironic because we were talking about how volatility was low, and I was saying that it seemed reasonably justified. Obviously, that was wrong. But what we saw happen last week was a deterioration of market conditions. In terms of like liquidity, forced stop outs in the middle of August, right? And so you had a pretty aggressive move lower down to 26K. And it happened at like in the afternoon, right? When like not many desks were on,
it was like 4 to 6 p.m. or so on Thursday night. Yeah.
And there's, lots of forced liquidations into, no liquidity basically.
I think
that's why we had that big move.
Yeah, I think we saw the largest, in Bitcoin specifically, the largest Bitcoin liquidation event since FTX.
Yeah. So this is on the magnitude of, FTX, Three Arrows.
Right.
So this was a very large liquidation event. Generally speaking, my approach to large liquidation events is they're normally good opportunities to fade the trend, right? Basically, all of the forced selling has had to happen, or most of it. Mm-hmm. And, most of the time, if you're on the other side of that trade, it tends to perform well, just because people are just so scared at that time. And so if you can, manage that anxiety, it's typically a good time to own assets, particularly alts. Alts tend to have the most exacerbated moves. And so, in the liquid alts in particular, you tend to get a very aggressive bounces when they happen, just from a percentage standpoint, because of things we've spoken about before, base effects
and lower liquidity.
Yeah,
I love that you said manage the anxiety. Is that like a large part of a trader's job? Is that like the main part?
It's like 95% of it, or not 95.
Yeah, I know.
It's a large portion of it.
So, and then the move, people were asking why, right? And there were some weird headlines, but none of them really lined up. But to me, it felt just like we've had a deterioration of the broader investing landscape globally.
No, absolutely.
What context would you put this? We'll call it the Bitcoin crash that happened last week. But
I think broader markets were generally selling off pretty aggressively.
For a couple weeks even.
A couple weeks, 2-3 weeks, right? It was Asian equities because of the Chinese deterioration, right? The bond market was selling off very aggressively, particularly in the back end, like everywhere. NASDAQ reacted, S&P reacted, like Euro stocks reacted, like Hang Seng.
Right.
Like there was a global risk-off move that occurred over the past couple of weeks, and we spoke about it last week, higher U.S. rates, so lower bond prices, lower equities, and a stronger dollar. These are all things symptomatic of a risk-off move.
Right.
And Bitcoin was holding up okay.
That's what I mean. It was
it
was strange. It was kind of like one of the last dominoes to fall. Usually, crypto is one of the first. I feel like in a risk-off. It held up for weeks at 29. It was just sitting there at 29.
No, I mean it just.
Eventually,
I think anecdotally, it seemed like you had a reasonable amount of positioning left in crypto, and you're not close to year end, et cetera. But if you're a crypto fund, like there's not really a compelling reason to be long aggressively at the moment.
Right.
And we spoke about it. It's really like Bitcoin is going to move on the ETF stuff once the ETF is actually like in the market and the flows can actually happen.
Right.
In terms of like how high Bitcoin can get to on just the hype of the ETF, we reached that pinnacle.
I think we did
already,
too,
which was 31.5.
Right.
And that's kind of your bar.
Yeah.
And in terms of like known buyers in the market right now, it's very few, right? It's MicroStrategy that has that the publicly announced
ongoing
purchase
Bitcoin program, yeah. Other retail aggregators,
retail aggregate, and then Tether, right?
They're gonna,
there's a wallet that's being tracked.
They're like
that
quarterly buying or whatever.
Correct.
Yeah. Right, it's not that much. I agree. And the narrative catalysts are pretty dry here. We got like some court cases to pay attention to. We keep the grayscale thing is so funny because like, everyone was like convinced that this, including should say I wasn't convinced, but I was also part of this analysis of following the grayscale ruling as very likely to come out in August. But now it's like so late in August that it's like maybe it isn't August, maybe it's months from now. It could be. And even then, like that's a weak catalyst, like a grayscale victory doesn't actually mean that doesn't really mean that much in the scheme of things. Yeah, so you're looking out at a narrative landscape that's pretty dry. I don't want to say bleak, but pretty dry of catalysts at the moment. I will say you start to approach the halving. We are starting to get into, I think in a couple months it'll be reasonable to start thinking about the halving's impact on Bitcoin prices and cycles. But even that, really, you shouldn't be. Historically speaking, 8 months out isn't like a major time. Yeah. So yeah, it's doldrums. It's a little bit of doldrums.
It's doldrums, and I think when you're in a world where there aren't too many crypto specific catalysts, I do tend to think that crypto follows the broader market as a whole, and so my outlook for the broader market is very rates oriented.
Yeah.
And I still am of the view that your risks are that. Inflation is there's the risk of reinflation. Commodity prices might start to move higher. The U.S. consumer is still strong, and data's generally holding up okay. Like imagine the U.S. economy right now can handle mortgage rates that are like 7-8% just fine. We just had like new home sales print 4% higher month on month.
That's wild.
And beat expectations.
Who is buying these homes at those rates?
Well, I mean, I think a ton of people.
And I think it's a lot. We were talking about a lot of cash buys.
Cash
right?
buyers,
yeah,
absolutely. Yeah. And it's just demographically, like a new family, right? They still need a home. They got to upgrade from an apartment. Well, fair enough.
I don't know.
Could. No, yeah.
But yes, I'm saying that you're right. That is a strong number. That 4% is a strong number.
It's super strong. And what you have to realize is that there's so many things that get impacted from a robust housing market, right? Like you buy a home, you need a plumber, electrician, construction, right?
Commodity,
like the state and locality that gets the taxes from the home, right? There's just such a multiplier effect to the housing industry, and it's still super strong. And the story is simple. Nobody, like the supply is tight because nobody wants to get out of their low mortgage.
Scarce asset.
Right?
Yeah.
And there's still buyers.
Right.
And people still have jobs.
So theoretically what? I mean, the basics are pretty simple until there are not buyers, right? Or people become forced sellers.
Or there's more supply.
Right. If they become forced sellers, or if the rest of the economy breaks down, people get laid off and stuff, they need to move to a cheaper home, then you see a supply influx.
But I mean, like
that's objectively not happening right now.
It's not.
So we still have that strength.
And so that's why I think the U.S. economy can handle higher interest rates. And this week we're actually going into Jackson Hole, which is happening. And the discussion is, part of the discussion at least is around neutral. Yeah. Like, what is the definition of like R-star neutral interest rates? Like, where is the baseline for the U.S. going forward?
Krugman finally came out and
I
just
don't believe
said
in
it.
Krugman.
I don't either, but he came out and said the Fed should target 3% instead of 2%.
Which is actually very interesting, given that he's a little more left.
He's on the closer on the more MMT dovish kind of side,
Correct.
more dovish.
Yeah.
That, for people are joking, wow, it's a 1% increase. No, dude, that's a 50% increase in the target. Some people are pointing out.
Yeah.
But
that's a big deal.
That is a big deal. Not so much that Krugman specifically is saying it, although he is influential. He's a New York Times columnist. He's got a large audience. But that would be a big deal if they did change the target. But we've talked about this before. Do you think, let's say would they ever even say they've changed? They would never say that because they would immediately get more inflation, right? They can't admit it, even if they kind of do soft target 3.
Yeah, no, it's a very hard thing to change, right? Especially given that decades of monetary policy have been based on an R-star around 2%, and that's the construct of like academia, etc. right now is around 2%, and it's not just the same for the U.S. We're talking Europe,
pretty global.
Global.
That's basically the global consensus for
2%.
A decent amount of inflation. That's not too much, but is good enough to
not too hot, not too cold.
Right.
And so
just right.
Basically. So it makes things challenging for them. Like communication is such a tough thing for them because they have to worry about their credibility at the same time. But all in all, what I think it highlights is a level of uncertainty around inflation and rates that is really unprecedented. And that makes owning assets, particularly long duration assets that have exposure to this variability in inflation and policy, much tougher.
Yeah.
Right? Because if expectations for neutral are moving around, expectations for inflation moving around like this, it's just really tough to stomach, especially if you're in a 20-year bond, which is why my favorite trade still is curve steepener.
Yep. Fimnat Abibi from Galaxy Trading, my friend. Thank you so much.
Pleasure.